Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at two of the biggest companies in the world, that is Apple and Microsoft, and we're deciding if investors should think about buying either one of the stocks heading into 2021. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, we're going to do a quick market overview before we dive into Apple and Microsoft. So on Monday morning, stocks fell big early on as countries across Europe and elsewhere started to bar travelers coming from Britain in an effort to slow some infections. There's a variant of the coronavirus that's reportedly spreading pretty rapidly in England at the moment. So that was the big news the market woke up to on Monday morning. But by midday, things were looking a little better. And the last time I checked, the Dow had actually gone into the green on the day. So that's the most recent updates on the coronavirus front. But more broadly, since early November, the bullish picture is trending, as I said, in that right direction, that bullish direction. So we saw that last week, care workers in the U.S. began to receive Pfizer's COVID-19 vaccine. Then just last Thursday, the FDA advisory panel recommended that Moderna's vaccine would be cleared for broad use. So on that note, federal officials are expecting more than about 100 million Americans will have been vaccinated by February or March, with the basic plan is to have healthcare workers and down the line of priority to get the vaccine. So obviously people around the world and Wall Street are hoping that the COVID-19 vaccine rollout proves successful and helps the hardest hit areas of the economy that require close human contact. They're able to bounce back as this is slowly rolled out over the next 6+ months or so. So that news alone helped, or the positive news alone, if we look back to early November, helped spark that wide market rally that went across all of the sectors and far beyond the pandemic winners. And obviously that's just based on the sense that this vaccine is going to prove to be a real effective way in getting people back into those close quarter businesses, as we mentioned. Then on another note, we saw that lawmakers in Washington reached a final agreement on a roughly $900 billion coronavirus relief package, which is moving Congress closer to the approval of a fresh infusion of cash to households, small businesses, and schools. And this is coming after months of gridlock on this second stimulus package. So look for that to be some news, maybe official news later in the day or later in the week. But that's, as we said, obviously been something that most investors in Wall Street have been assuming it was going to happen for a while, especially as we saw more businesses now have to be forced to shut down again, and they're likely to face a really harsh winter around more and more restrictions. With that said, along with the more speculative nature of the vaccine proving to be a big hit, the earnings picture and the interest rate environment both set up a rather bullish picture for 2021. Pretty much no matter what's happening, the earnings picture was improving well before any of that positive vaccine news came out in early November. And the interest rates are expected to stay low for at least the next few years, with the Fed saying they're going to keep their core interest rate near zero through at least 2023. So obviously that's going to help with stocks as investors are looking for a place to make some returns in that low yield environment. That said, it's maybe not the best time to just dive right back into some of these person-to-person contact heavy businesses, as we just saw with the travel restrictions now back in London. Especially during the winter, it's unclear exactly what's going to happen in the near term on that. And despite some recent strength of some beaten down spaces and cyclicals, it seems pretty obvious that technology is going to dominate our lives and the market going forward. So with this in mind, we're going to take a look at two of the world's largest companies that are also the world's largest tech companies. As we mentioned, tech it's not going anywhere. In fact, it's just going to become more and more important to all of our lives going forward. And obviously the two companies we're talking about today, as I mentioned up top, are Apple and Microsoft. And we are going to start with Apple. For those of you who don't know, Apple trades in the ticker AAPL. The stock has climbed about 11% in the last month. This helps it double the tech sector's about 6% average climb. This is part of a 3-month stretch that's seen Apple roughly match the tech space's 15% run. We should note that some of the recent positivity is part of, obviously, that broader market sentiment that's seen all three major U.S. indexes reach new records over the last several weeks. And then we should also know that in mid-December, a report surfaced that Apple was increasing production of its 5G iPhones amid surging demand. So the company is reportedly planning to produce between 95 to 96 million iPhones in the first half of 2021. This would mark a nearly 30% increase from a year earlier. The company has not confirmed that, obviously, with this target including, as we mentioned, those new 5G iPhones, those iPhone 12s, as well as some older models as well. Before we dive into more going forward, we should just touch briefly on the antitrust cases that are hitting some of these big tech companies. Apple is implicated in the U.S. Department of Justice's antitrust lawsuit against Google, where it's focusing on Google's relationship. In part of the lawsuit is focusing on Google's relationship with Apple. So it's worth just quickly touching on that. So Google relies heavily on search traffic from iPhones, where its flagship search engine is the current default on Apple's Safari phone browser. So the two tech giants don't necessarily release the financial significance of that mutually beneficial relationship, but we should note that reports say that Google pays Apple between $8 to $10 billion a year to be the default search engine on iOS devices. The DOJ lawsuit projects that partnership could account for between 15 to 20% of Apple's annual profits. So it's certainly worth keeping an eye on that. That said, despite all of these concerns, Google and Apple will obviously fight back. They're fighting back against any of this. Lawsuits and litigation could take years and years. And people in Washington have been looking more closely at tech companies over the last several years. And obviously, investors in Wall Street haven't been that nervous to help these stocks reach new highs. But it is just worth keeping an eye on that relationship with Google and Apple, and how the U.S. government is diving a little deeper into that as well. And obviously, we should note that there's other things going on with Alphabet and Amazon and Facebook. And with all of that in mind, Apple has definitely tried to focus more on its privacy protections for its customers, and it's promoting that. It's been promoting that over the last year, and it's certainly been promoting more of that in its ads more recently as tech comes under scrutiny, as we've mentioned before. So with that out of the way, we're going to look back a little bit. So its new iPhone 12 launched in late October. It's the first 5G capable phone. The company priced its higher-end models roughly the same as last year's iPhone 11s, despite the fact that it has these 5G capabilities. And the reasoning is pretty clear that at the moment, 5G is still really in the early days, and AT&T and many of its peers still have miles and miles and miles to go before this next generation wireless network is anything near reaching what the current network does in terms of actual physical area where you can access this 5G network. But that said, 5G is certainly the next generation. It's going to play a role for years and years to come. So it's good to note that Apple is slowly rolling out a phone that has that capability behind it. And then before we jump in even further, it's always worth remembering, just when you're thinking about ever buying Apple, that Apple is still one of the best marketers and maybe one of the best retailers in the history of the world, or at least you could say the history of the last century. And it remains the world's most valuable brand. So that's always worth noting. That's on top of all the other tech players, and on top of Nike and McDonald's and all the other globally recognized brands. And it was able to grow its fiscal 2020 revenue by roughly 6% during a year where there was a global pandemic and economic crisis that followed suit. And it's a high-end consumer tech firm. So that's just worth noting that it was able to grow its top line at about 6% when all of these really negative factors were going on during the world. Apple's iPhone continues to be its largest business, and its Mac and iPad sales saw a big surge during the remote school and work push earlier this year. On top of that, its wearables unit, which features its wireless AirPod headphones and its Apple Watch, its smartwatch have continued to grow in popularity. And then maybe more important than all of this is Apple's massive services business that includes its App Store and now many of its own subscription services. This includes Spotify competitor Apple Music, its streaming TV service that hopes to be able to compete against Netflix and Amazon Prime and Disney Plus for years and years to come. It has a news offering, a video game service. The company even recently rolled out a new fitness app that is trying to help it compete alongside Peloton and Mirror, which Lululemon purchased, as more and more people are working out at home, and maybe some of the last things to come back will be gyms, even if the vaccine is rolled out pretty effectively. With this in mind, Apple's paid subscriptions grew by 35 million last quarter to over 585 million paid subscriptions across its various services. This is up 135 million from a year ago period. So with that said, the company is, quote, very confident that it will reach its increased target of roughly 600 million paid subscriptions before the end of calendar year 2020. So just over the next week or so, the company expects that it will end the year with 600 million paid subscriptions across all those services. And this is really where Apple is hoping that its products, then if you use its products, you also use its services, and it's to become more of a closed loop that also provides a more sustainable revenue generation instead of these iPhones where people only buy them maybe once every 2 years or so. So with this in mind, we're going to take a look ahead. Oh, we should also note that Apple is currently working on bringing more of its chips in-house. The move is projected to help it cut costs and improve battery life and performance and even more things. So it's certainly worth paying attention to that. It's another thing that Apple's trying to increase its reach, and as I said, just bring more things in-house. And it's certainly going to be worth monitoring how the progress goes on that. That's already affected some chip makers' stock prices over the last several months or so, as Apple has made more progress on that in-house chip push. So with this in mind, the company's sales are expected to climb 12% in the coming quarter, the current quarter. This is based on our Zacks estimates. And then it's expected to jump about 17% this year from about $275 billion this past year all the way up to $320 billion. And then it's expected to jump another 4% next year all the way up to $334 billion. So making just tons and tons and tons of money. And then on the bottom line, our estimates are calling for Apple's adjusted earnings to climb about 23% this year and then another 9% next year. And in terms of that top line growth, as we just mentioned, the company did about 6% growth in 2021. This came on the top of about a 2% decline in 2019. And as we mentioned, we're calling for about 17% growth on the top line this year, which would mark its strongest growth over the last 5 or 6 years. It did about 16% growth in 2018. So that's worth noting. And then actually, if we look back, the last time it did more than 17% growth, it was in 2015. It did 28% growth. But just as we mentioned, that's also in fluctuation with when those iPhones are coming out and its next generation phones. So the subscription services revenue is obviously going to continue to smooth that out, but still it's an iPhone heavy business that's going to have those big swings in some of its top line growth. If we look at the bottom line estimates, the company's estimates have been trending in the right direction since its last report, even though it is still currently a Zacks rank number 3 hold. And then more broadly, we should note, and this is another thing to consider when you're thinking about buying Apple stock, the company closed its fiscal year with $79 billion in net cash. And at the end of the quarter, the company continues to note that it's trying to eventually reach a cash neutral position. So it's going to continue to spend money. And this is why you might want to think about buying Apple, even for no other reasons. The company returned nearly $22 billion to shareholders during the September quarter. This is including $3.5 billion in dividends and it also repurchased about $18 billion through open market repurchases of its stock. So it's continuing to buy back stock. It is continuing to pay dividends. It has about $80 billion in net cash that there alone might be worth the price of entry. And we should also note that its dividend yield currently rests at about 0.66% at the moment, which is not the highest, but it's kind of an added bonus for a stock that's the biggest in the world and looks poised to grow for years and years to come. It's currently trading at about 6.6 times forward sales as well, which is up above its median over the last year, but it's certainly below its highs of about 7.4 times forward sales over the last year. So it's stretched a little bit, but you could say that about the broader market in general, if that's how we're looking at it. And then in terms of forward earnings, it's trading at about 31 times forward earnings, which is a little bit above the tech sector's average, but it's also well below its own highs of about 36 over the last year. As we mentioned, Apple is currently Zacks ranked number 3 hold, and it sports an A grade for momentum in our Scala score system. We should note, most people probably know this at this point, the company's stock soared after it announced its 4-for-1 stock split earlier this year. It's a purely cosmetic move. Apple's done it before. The basic principle is to help make its shares look more attractive and attainable to a wider array of investors. So with that in mind, the stock is trading, the stock's trading at about $126 per share as of Monday morning, which puts it about 7% off its early September records, which means it could certainly have more room to climb. In longer term, investors, in my opinion, can't really go wrong buying Apple at a 7% discount if you have a year or more outlook on a stock. Certainly if you have like a 10-year outlook, it doesn't seem like too much of a stretch to say Apple is certainly worth buying. We should also note that at $126 per share, and this is why they did it, it looks far more attractive to the average investor when you consider Amazon's trading at $3,200 per share. Google's trading at $1,700 per share. They're trading at $126 per share. We should also note that of the 25 analysts that we have brokerage recommendations for at Zacks, 17 have Apple as a strong buy at the moment, with 3 more at a buy and 5 at a hold, and none have it as a sell or a strong sell at the moment. So that's where Apple's standing at the moment. As we mentioned, if you're a longer term investor, it certainly seems worth considering buying Apple as we head into 2021 and for years and years to come. It's trading at about 7% discount to still its September records, even as the market and other tech peers have reached new highs in November and December. So now we're going to move on to Microsoft. It's another company that really hasn't needed an introduction to investors or the general public for decades. But if you need a refresher, the company trades under the ticker MSFT. And despite not needing an introduction, it's arguably more influential and diversified today than at any point in its history. This has a large amount to do with its ability to expand into this ever-growing cloud computing market. It's now a cloud computing titan alongside Amazon, and its cloud efforts now play a role in nearly every facet of its business, which includes its office business that remains invaluable to countless businesses, organizations, schools, etc. around the world. Microsoft is also set to grow within the global gaming market. For instance, its Xbox and content services revenue climbed about 30% last quarter. We should also note that its portfolio of remote work and business communication offerings have continued to become more and more important. And during this at-home or work-from-home environment, they've drawn even more attention. Like with Apple, it's got a big cash position. It held about $137 billion in cash and equivalents at the end of last quarter. This will help it continue to make strategic acquisitions, both big and small, as it's continued to do this for years and years and years. And it helps it weather nearly any possible economic storm. We should also note that over the weekend, reports broke that Microsoft is designing, like Apple, is now designing its own chips for servers, Surface PCs, and more. So that helped the stock climb over 2% on Monday. The stock is now up 42% in the past year and 160% in the past 3 years. And at about $223 per share, it's currently resting at about 4% off its September highs. So like with Apple, the stock is trading below those early September highs, even though a lot of other tech stocks and the market itself have climbed back to new records. So it's certainly worth, as we mentioned with Apple, if you're a longer term investor, it's nothing earth shattering to say. It certainly seems like a solid idea to buy Microsoft if you have, say, a 6-month, year, 10-year, whatever, long term investing. It's not much of a challenge to say you want to buy Microsoft. So on the valuation side, the company's trading at about 10 times forward 12-month sales, which sits below its recent highs of at about 11. And obviously, it marks a little bit of a premium compared to the broader tech sector, but obviously investors have been willing to pay a little bit of a premium for Microsoft for years, and obviously for good reason. Peeking ahead, our Zacks estimates are calling for Microsoft's revenue to climb about 10% in both the next year, 2 years, so 10% in fiscal 2021, which is its current year, and then another 10% in FY 2022. The firm's projected top-line growth would follow 3 straight years of between 13 to 15% revenue expansion, which is really highly impressive for a firm of its size and age. And then unlike Apple, where it has those fluctuations in big growth and then slower growth, Microsoft's business much more stable. So projected to do 10% growth this year, 10% growth next year. That's coming off, as we mentioned, the stretch where it did between 13 to 15% growth over the last 3 years. And then on the bottom line, we're expecting its adjusted earnings to climb about 17% this year and then another 10% next year. And its positive earnings revisions help it grab a Zacks rank number 2 buy at the moment. Plus, its 1% dividend yield currently beats the 10-year U.S. Treasury, which is sitting at about 0.9% at the moment. It also tops Apple's, as we just mentioned. And investors should note that clearly Microsoft, as with Apple, has faith on Wall Street. Currently, 21 of the 24 brokerage recommendations that Zacks has for Microsoft are at a strong buy, with 2 more at a buy. And then most recently, Monday morning, we should note that Citigroup analyst Walter Pritchard raised his rating from neutral to buy, and he lifted his price target by 19%. This is based on cloud growth expectations. It's one of the most bullish calls on Wall Street at the moment, and that helped Microsoft stock jump over 2% on Monday morning, even as the broader market continued to fall. So a little bit less to touch on than I did with Apple, but in general, if you're a longer-term investor, and this is nothing controversial to say at all, you have a longer-term investment horizon, it seems like Apple and Microsoft are both still surefire bets. They pay a dividend. They have a lot of cash. They're expected to continue to grow for years and years to come, and they're both sitting below their recent highs. And yeah, as I mentioned, it seems like a pretty surefire bet for either Apple or Microsoft at the moment. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.